China's silver demand has always mattered. What has changed is how directly it is beginning to interact with assumptions embedded in Western market infrastructure. For years, COMEX inventories have been treated as adequate, buffers sufficient to absorb shifts in physical demand without altering broader market behavior. That assumption is now being quietly tested. The testing is not dramatic. There are no official shortages declared, no emergency measures announced. Instead, the signal appears through patterns, delivery interest that persists longer than expected, inventory movements that draw attention without explanation, and a growing sensitivity to physical flows that were previously dismissed as marginal. China's role in the silver market is not new, but it is often misunderstood. Chinese demand is not primarily speculative. When China accumulates silver, it does so to support manufacturing capacity, technology supply chains, and long-term resource security. These motives operate independently of short-term price movements and Western financial narratives. This distinction matters because COMEX inventory assumptions are built around flexibility. The system assumes that metal can be mobilized when needed, that delivery interest will remain manageable, and that paper markets will continue to intermediate between physical supply and financial demand. They become fragile when it is not. Recent activity suggests that physical silver is being absorbed in ways that are less responsive to price signals and more aligned with strategic procurement. When that happens, inventories do not vanish overnight. They become less available. Optionality narrows. The market still functions, but with less slack. This is where the risk is often misread. Observers look for visible stress spikes in premiums, delivery failures, or public warnings. Instead, the more relevant signal is behavioral. How quickly inventories are replenished. How readily metal is offered. How confidently market participants rely on existing buffers. China's silver demand is forcing these questions back into focus, not because it overwhelms the system, but because it challenges the assumption that the system can always adapt without consequence. If you follow silver through structural lenses rather than headline narratives, this is where attention becomes useful. Consider subscribing. If this kind of analysis focused on how institutional assumptions are tested quietly rather than broken, loudly aligns with how you prefer to understand markets. The key issue is not whether COMEX inventories are sufficient today. It is whether the framework used to assess sufficiency still holds under changing patterns of demand. To understand why this matters beyond silver and why inventory assumptions play such a central role in market confidence, we need to examine how physical demand interacts with paper market structure when strategic buyers enter the equation. COMEX inventories are often discussed as static numbers, but in practice they represent a dynamic system of expectations. What matters is not just how much metal is reported, but how confidently the market believes that metal can be mobilized when required. That confidence rests on a set of behavioral assumptions that are rarely examined unless they are challenged. One of those assumptions is that physical demand will remain responsive to price. In most Western market frameworks, demand is expected to slow when prices rise and accelerate when prices fall. This logic underpins inventory management, hedging strategies, and delivery risk models. It works well when demand is discretionary. It works less well when demand is strategic. It is shaped by industrial planning cycles, state-supported manufacturing priorities, and long-term supply security considerations. These drivers do not adjust smoothly in response to short-term price fluctuations. When procurement decisions are made within this framework, they are executed with persistence rather than timing sensitivity. This is where tension begins to form. COMEX inventory assumptions implicitly rely on the idea that large-scale physical demand will ebb and flow in a way that preserves optionality. Strategic demand does the opposite. It removes metal from circulation with limited regard for near-term market conditions, reducing the pool of metal that inventories are meant to represent. The impact of this removal is subtle. Inventories may still appear ample, reported totals may not change dramatically, but the quality of those inventories shifts. The confidence that delivery can be sourced without friction begins to erode at the margins. Markets are slow to price this erosion because it does not present as a clear event. There is no single data point that signals a change in regime. Instead, there is a gradual increase in sensitivity. Delivery requests are watched more closely. Inventory movements attract more attention. The margin for error narrows without announcement. Paper markets continue to function during this phase, and that continuity can be misleading. Futures contracts roll. Prices remain orderly. Volatility stays contained. This reinforces the belief that inventory assumptions remain valid. In reality, the system is leaning more heavily on those assumptions than before. The risk here is not immediate shortage, it is miscalibration. When strategic demand interacts with systems designed around flexible demand, stress is redistributed rather than resolved. It accumulates quietly, often in places that are not visible to headline-driven analysis. Understanding this helps explain why inventory discussions often feel disconnected from price behavior. Price reflects marginal transactions. Inventory confidence reflects structural resilience. The two can diverge for extended periods. China's silver demand is not breaking COMEX inventories. It is testing the assumptions that allow those inventories to function as stabilizing mechanisms. That distinction is important. Systems rarely fail at the point of first stress. They fail when assumptions are no longer aligned with reality. To see how this testing can influence market behavior beyond inventory statistics, we need to examine how participants adjust when confidence in availability becomes conditional rather than absolute. When confidence in inventory availability becomes conditional rather than absolute, market behavior changes in ways that are rarely captured by standard metrics. This is the phase where assumptions are no longer taken for granted, but they are not yet openly questioned either. Participants begin to operate differently without formally acknowledging that anything has shifted. In the context of COMEX, inventories are not merely a stock of metal. They are a psychological anchor. They reassure market participants that physical obligations can be met, that settlement pathways remain flexible, and that paper exposure remains safely abstracted from physical constraint. Once that reassurance weakens even slightly, the system begins to behave more cautiously. This caution does not take the form of panic or withdrawal. Instead, it appears as selectivity. Market participants become more attentive to delivery mechanics. They reassess assumptions about how quickly metal can move from registered to available status. They pay closer attention to who holds inventory and under what conditions it is likely to be mobilized. These questions matter because inventories are only stabilizing if they are credible. Credibility is not binary. It exists on a spectrum. When confidence is high, inventories are treated as interchangeable. When confidence narrows, distinctions emerge. Certain bars are considered more available than others. Certain delivery windows are viewed as more reliable. Optionality begins to fragment. China's silver demand contributes to this fragmentation not by overwhelming the system, but by introducing persistence. Strategic demand does not test inventories through sudden spikes. It tests them through steady absorption. Each incremental removal of metal reduces the pool that markets quietly assume is accessible. Over time, this changes how risk is managed. Paper exposure becomes less attractive when the path to physical settlement feels less certain. Hedging strategies are adjusted to reduce reliance on delivery assumptions. Leverage is managed more conservatively, not because volatility has increased, but because confidence has narrowed. This is where many observers misinterpret what they are seeing. They look for visible stress and find none. Prices may remain stable, spreads may remain contained, volumes may appear healthy. From a distance, the system looks unchanged. But internally, it is adapting. Adaptation has consequences. When participants become more cautious about relying on inventory buffers, liquidity becomes more conditional. Trades still occur, but with greater sensitivity to timing and counterparty. The market remains functional, but it becomes less forgiving. This shift also affects how new information is processed. In a system with high confidence, unexpected demand can be absorbed easily. In a system operating with conditional confidence, the same demand triggers reassessment. Market participants ask not whether the system can handle it in theory, but whether it can handle it in practice. China's role intensifies this reassessment because its demand is not reactive. It does not fade quickly when prices move. It does not pause for market narratives. It reflects longer-term priorities that sit outside the feedback loops Western markets are accustomed to. This creates a mismatch in expectations. Western market structures assume that demand responds to incentives. Strategic demand responds to necessity. When these frameworks interact, the system absorbs the difference quietly until it cannot do so effortlessly. Importantly, none of this implies that inventories are about to be exhausted. That framing misses the point. What matters is not depletion, but reliability. A system can have ample resources and still experience stress if those resources are less available than assumed. This is why inventory assumptions are so central to market confidence. They are not about quantity alone. They are about trust in process. When that trust becomes conditional, markets behave differently even if the numbers look unchanged. Over time, these behavioral changes feed back into pricing indirectly. Volatility may remain muted, but sensitivity increases. Small changes in demand or supply produce larger reactions than before. The market becomes more reactive not because it is unstable, but because it has less slack. China's silver demand is therefore acting as a probe. It is not forcing a break. It is revealing how much flexibility the system truly has. Each interaction tests whether inventory assumptions still hold under real-world conditions rather than theoretical ones. Understanding this distinction is essential. Markets rarely reprice at the moment assumptions are tested. They reprice after behavior has already changed. By the time the adjustment becomes visible, the underlying shift has already occurred. To see how this process moves from internal adjustment to external signal and why it often surprises observers, we need to examine how inventory credibility eventually intersects with pricing and perception. When inventory credibility begins to erode, even subtly, the effects do not surface immediately in price. They surface first in perception. Market participants start to reassess not what inventories report, but what inventories represent. This distinction is critical because perception governs behavior long before numbers change. COMEX inventories function as a bridge between paper markets and physical reality. They allow futures markets to operate at scale by creating confidence that physical settlement is possible if required. As long as that bridge is trusted, most participants never feel the need to cross it. Paper exposure remains abstract. Liquidity remains abundant. When trust in that bridge becomes conditional, the system does not collapse. It becomes more selective. Participants begin to treat physical availability as a variable rather than a constant. Delivery is no longer assumed to be frictionless. The question shifts from "is metal available?" to "under what conditions is it available, and to whom?" That shift alone changes market dynamics. This is where strategic demand becomes particularly influential. China's silver demand does not need to overwhelm inventories to matter. It only needs to demonstrate persistence. Persistent demand reframes expectations. It suggests that metal leaving circulation may not return quickly, if at all. That possibility alters how remaining inventories are valued not in price terms initially, but in confidence terms. As confidence narrows, market participants adapt defensively. Some reduce exposure to contracts that imply delivery risk, even if that risk remains theoretical. Others adjust hedging strategies to rely less on assumptions of instant availability. Inventory holders become more deliberate about how and when metal is released. None of these actions generate headlines. They generate friction. Friction increases the cost of maintaining balance. Trades still clear, but they require more negotiation. Liquidity is present, but it is less automatic. The system still functions, but it demands more attention. This is the stage where markets often misjudge their own resilience. The absence of overt stress is interpreted as confirmation that inventory assumptions remain valid. In reality, the system is compensating for reduced confidence through behavior. It is working harder to achieve the same outcomes. That compensation has limits. As friction accumulates, sensitivity increases. Markets become more reactive to marginal changes. Small inventory movements attract disproportionate attention. Routine delivery requests are examined more closely. The margin for error shrinks. This is not instability. It is adaptation under constraint. China's role in this process is indirect but meaningful. By absorbing silver steadily and strategically, it reduces the system's ability to rely on recycling, substitution, or short-term supply responses. That reduction does not force immediate repricing. It forces reassessment. Reassessment is where perception and structure meet. Once participants internalize that inventories may not be as flexible as assumed, they begin to price risk differently, even if prices themselves remain stable. Volatility becomes less predictive. Confidence becomes more important than momentum. This is why inventory credibility matters beyond silver. It speaks to how modern markets manage the relationship between abstraction and reality. Paper markets are efficient precisely because they distance participants from physical constraints. When those constraints reassert themselves, even quietly, efficiency gives way to caution. Understanding this helps explain why markets often appear calm right up until they are not. The calm reflects adaptation, not absence of pressure. Pressure is being redistributed, not eliminated. To complete the picture, we need to examine how this quiet redistribution eventually becomes visible, and why the transition from internal adjustment to external recognition often happens faster than expected. To complete the picture, we need to examine how this quiet redistribution eventually becomes visible, and why the transition from internal adjustment to external recognition often happens faster than expected. Chapter 4, Complete. Continue Chapter 5 and Final. Continuing with Chapter 5 and concluding the analysis in full. The final phase of this process is not a sudden break. It is recognition. Markets eventually acknowledge what participants have already internalized through behavior. By the time that recognition becomes visible, the underlying adjustment has largely occurred. This is how inventory assumptions stop being theoretical and begin to influence outcomes. When confidence in COMEX inventories becomes conditional, pricing does not immediately respond. Instead, the relationship between price and behavior changes. Markets become less willing to treat price as a complete signal. Availability, timing, and counterparty trust begin to matter more than nominal levels. This is the point at which observers often believe something suddenly changed. In reality, the change has been unfolding quietly for some time. Strategic demand, like China's silver procurement, does not shock the system, it reshapes it. Each incremental absorption of metal reduces flexibility just enough to alter expectations. Eventually, those altered expectations surface. They surface when price responds more quickly than models predict. They surface when delivery interest attracts attention out of proportion to its size. They surface when inventories that once felt abundant are discussed in terms of quality rather than quantity. At that stage, the system is no longer operating on old assumptions. It is operating on revised ones. The supply of silver has not collapsed. COMEX has not failed. But the belief that inventories are a neutral, elastic buffer has weakened. This matters because belief underpins liquidity. When participants trust that physical settlement is always possible, paper exposure can expand safely. When that trust narrows, paper markets continue to function, but with more restraint. Leverage is extended more cautiously, duration shortens. Optionality is valued more highly. These changes do not require a crisis to matter. They affect how markets transmit stress. In systems with ample slack, stress is absorbed invisibly. In systems operating closer to constraint, stress is transmitted more directly. China's silver demand plays a role here not because of volume alone, but because of intent. Strategic demand removes metal from circulation without regard for near-term market convenience. That forces Western market structures to confront the difference between theoretical availability and practical access. This confrontation does not lead to failure. It leads to repricing of assumptions. Over time, that repricing influences how participants interpret data. Inventory reports are read more carefully. Physical flows are monitored more closely. The distinction between registered and available metal becomes more than technical. It becomes meaningful. This is the point at which markets often reassess narratives. What was once framed as routine demand is reinterpreted as structural pressure. What was once dismissed as noise is reconsidered as signal. The transition feels abrupt only because the groundwork was laid quietly. For professionals, researchers, and observers focused on structure rather than headlines, this is the key takeaway. The most important shifts in markets rarely announce themselves. They emerge through behavior, then surface in perception, and only later appear in price. China's silver demand is not emptying COMEX inventories. It is testing the assumptions that allow those inventories to function as stabilizers. That test is ongoing. Its outcome will not be binary. It will be reflected in how markets adapt. Understanding this distinction helps avoid common errors. It prevents the search for dramatic endpoints. It refocuses attention on process. Markets do not wait to reprice until constraints are breached. They reprice when confidence in flexibility erodes. If this framework has clarified why silver inventories matter beyond headline numbers, consider sharing it with others who study markets through institutional and structural lenses. And if you've observed similar dynamics in other commodities or systems, add your perspective in the comments. These patterns often repeat across markets, even when the assets differ. The most important signal is not whether inventories fall to zero. It is whether markets continue to believe they don't have to.